Why do smart people make dumb investing decisions? It's not because they lack knowledge or experience. It's because they're human, prone to emotion, driven by fear and greed, swayed by the crowd. In The Psychology of Investing, How Biases Influence Financial Decisions, John R. Nofsinger dives deep into the mental traps and emotional pitfalls that sabotage even the most well-intentioned investors. This book isn't about picking the right stocks or timing the market. It's about understanding yourself, because the biggest risks aren't out there in the economy or the headlines. They're inside your own head. Nofsinger explores how overconfidence, regret, herd behavior, and even biology influence your financial choices. Through real-world examples, surprising research, and relatable stories, he reveals why we do what we do with our money, and how to break free from those invisible patterns. If you've ever panicked during a market crash, jumped into a hot stock just because everyone else was, or clung to a bad investment out of pride, this book is for you. It's for the curious, the frustrated, the cautious, and the bold. It's for anyone who wants to turn the mirror inward and become a better investor by becoming a wiser human. In the chapters ahead, you'll uncover the hidden psychology behind every financial move you make. And once you understand it, you can finally start investing not just with your wallet, but with clarity, confidence, and control. Chapter 1. Psychology and Finance. Picture this. You're sitting at your kitchen table, sipping your morning coffee, browsing through the financial news. The headlines scream about stock market crashes, record highs, and economic turmoil. Your gut twists a little, your palms sweat. And even though you promised yourself to stick with your investment plan, a little voice whispers, maybe it's time to pull out. That little voice, that's not logic, that's psychology at play. In this opening chapter, John R. Nofsinger introduces us to the marriage between two seemingly different worlds, psychology and finance. For decades, traditional finance has assumed that investors are rational beings, kind of like robots, who process all available information and make perfectly logical decisions to maximize wealth. But the real world? It's messier. People are emotional. They make decisions based on fear, greed, pride, and regret. They follow the crowd, react to news with their hearts instead of their heads, and often act against their own best interests. That's where behavioral finance steps in, a field that blends psychology with investing to better explain why people do what they do with their money. Nofsinger begins by pointing out that most people believe they make smart financial choices. But statistics tell a different story. For instance, individual investors tend to underperform the broader market significantly. Why? Not because they're not smart, but because they're human. And being human means falling prey to biases, emotional impulses, and mental shortcuts. One of the most powerful examples Nofsinger shares is the dot-com bubble of the late 90s. Remember that? Tech companies with little to no revenue were skyrocketing in value. People invested not based on fundamentals, but on hope, hype, and herd mentality. When the bubble burst, it wiped out billions of dollars of wealth. And it wasn't because people lacked information. It was because they let emotion overrule logic. The chapter also makes a strong case for why understanding investor psychology is critical, not just for individual investors, but for professionals too. Fund managers, financial advisors, and even economists have biases. If they're unaware of those biases, they can lead clients or even entire economies into trouble. To bring the point home, Nofsinger introduces the concept of bounded rationality. This basically means that while people want to make good decisions, they are limited by the amount of information they have, the cognitive shortcuts their brains take, and the emotional baggage they carry. Imagine you're trying to pick the best mutual fund out of hundreds. Even with a spreadsheet, ratings, and past performance data, Your brain is overwhelmed. So what do? You pick the one with the highest recent return, or the one your friend just invested in. That's bounded rationality in action. He also breaks down why traditional financial models fall short. Models like the efficient market hypothesis, EMH, assume that markets instantly and accurately reflect all information. But behavioral finance challenges that. Markets are made of people, and people are flawed. That means markets are sometimes irrational too. A powerful metaphor Nofsinger uses is comparing traditional finance to physics, clean, predictable, and mathematical, and behavioral finance to biology, complex, adaptive, and messy. In physics, you can predict how a ball will bounce. In biology, predicting how a dog will behave when you throw the ball. Much harder. Investing is more like biology. Another fascinating idea he explores is the difference between descriptive and normative models. Normative models tell us what investors should do, kind of like a financial textbook. Descriptive models, on the other hand, explain what investors actually do. Behavioral finance is all about the descriptive side, understanding real human behavior. By the end of the chapter, you start to see investing not just as a numbers game, but as a deeply psychological experience. Every click of the buy or sell button is loaded with emotion, memory, and even subconscious influence. Maybe your parents lost money in the market, so you're overly cautious. Maybe you had a big win once, and now you're too aggressive. These personal histories color your decisions, often more than you realize. Nofsinger doesn't just explain concepts. He tells stories. He wants you to see yourself in these examples, to realize that the irrational investor isn't some other guy. It's you, it's me, it's all of us. The biggest takeaway: if you want to be a better investor, you have to first become a better observer of yourself. Knowing the market is important, but knowing your own mind is even more powerful. So, what can you do with this information? Start by acknowledging that your financial decisions are influenced by more than just facts. Monitor your emotional state before making investment choices. Are you feeling anxious, euphoric, envious? Then maybe hit pause. Keep a decision journal. Jot down why you're buying or selling an asset. Later, you can revisit your thought process and see where emotion crept in. And most importantly, don't beat yourself up for making mistakes. Everyone makes them. The goal isn't perfection, it's awareness. In closing, this first chapter sets the tone for the rest of the book. It opens your eyes to the idea that investing isn't just about money. It's about mindsets. It's about learning to recognize your own internal biases so you can step out of your own way. Because once you understand your psychology, you're no longer just reacting to the market. You're navigating it with intention. And that's how you start transforming from an emotional investor into a wise one. Chapter 2. Overconfidence. Imagine walking into a casino, placing a bet, and winning big on your first try. The adrenaline rush hits hard. You feel sharp, unstoppable. Suddenly, you're not just lucky, you're good. You double down. And that's when it happens. You lose it all. That's overconfidence at work. In this chapter, Nofsinger dives into one of the most pervasive psychological traps in investing: overconfidence. It's the belief that we're better than we actually are, smarter, more informed, and more skilled at predicting the future. And in the world of money, that belief can cost us a lot. Here's a fun stat to chew on. In surveys, about 80% of people say they're better than average drivers. Mathematically, that's impossible. We can't all be above average, but the same illusion happens in finance. Investors believe they can beat the market, time their trades perfectly, or pick the next apple before anyone else. Overconfidence isn't just about arrogance. It's often unconscious. You might think, I've done my research, I know this company inside and out, this is a sure thing. But no matter how confident you feel, Your information is incomplete, your predictions are uncertain, and your emotions are in play. Nofsinger shares a striking example involving individual investors who actively trade stocks. Studies show that the more they trade, the worse they perform, often underperforming the market by several percentage points. Why? Because they think they know when to buy and sell, but more often than not, they're wrong. The data is clear. Overconfidence leads to overtrading, which leads to underperformance. He introduces the concept of illusion of control, where people think they have more control over outcomes than they actually do. Let's say you roll dice harder when you want a high number, or you pick your own lottery numbers instead of using random ones. That tiny feeling of control, it's comforting, but it's also a lie. In investing, this illusion leads to risky behavior. People may ignore diversification and pile money into one or two hot stocks. They may chase returns based on gut instinct instead of research. They trust their instincts and forget how unpredictable markets truly are. Another layer of overconfidence comes from past success. If you picked a few winning stocks, suddenly you feel like a genius. You tell yourself it wasn't luck, it was skill. But as Nofsinger points out, even random chance can look like talent over the short term. It's only over the long term that true skill reveals itself, and most investors don't have it. Then there's the self-attribution bias. That's when we take credit for wins but blame losses on outside forces. I made that great pick because I'm smart, we say, but when things go south, the Fed changed rates or the economy tanked, this mindset feeds the overconfidence monster. It protects our ego, but it stops us from learning from our mistakes. Nofsinger also brings attention to how gender can influence financial behavior. On average, men tend to be more overconfident in investing than women, especially single men. Research shows they trade more often, and as a result, earn lower returns. Women, being more cautious, tend to hold investments longer and outperform men slightly. It's not about being less capable. It's about being more aware of the limits of their knowledge. Another powerful anecdote comes from the corporate world. Executives often buy back shares of their own companies, thinking the stock is undervalued. Yet, on average, their timing is no better than random. Even insiders, people with deep knowledge of their own business, fall prey to overconfidence. So what can you do to protect yourself? First, embrace humility. Acknowledge that markets are complex and unpredictable. No matter how much experience or research you have, you're not immune to mistakes. Second, resist the urge to trade too frequently. The more you buy and sell, the more opportunities there are for emotion and overconfidence to creep in. Instead, build a diversified portfolio and stick with it. Third, keep track of your investment decisions and your reasoning behind them. Later, you can revisit those decisions to see whether you were guided by facts or by ego. This decision journal technique is powerful. It forces you to confront the truth about your investing skills and learn from both wins and losses. Also, avoid overreacting to short-term market movements. That "I've got to do something" feeling after a drop? That's your overconfidence trying to regain control. Sometimes the smartest move is no move at all. And if you're working with a financial advisor, ask questions, but also listen carefully. Advisors, too, can be overconfident. Make sure their strategies are grounded in data and not just conviction. Ultimately, this chapter isn't meant to make you doubt yourself completely. It's about balance. Confidence is good. It helps you take action. But unchecked confidence, that's a recipe for disaster. Nofsinger's core message here is this: the best investors aren't the boldest, the smartest, or even the most experienced. They're the most self-aware. They know their weaknesses. They admit what they don't know, and they build systems to protect themselves from their own bad instincts. So next time you feel sure about a hot stock tip or a perfect trade, pause. Ask yourself, am I acting on facts or just feeling too sure of myself? That moment of reflection could save you thousands of dollars, because in the world of investing, confidence gets you started, but humility keeps you in the game. Chapter 3. Pride and Regret. Let's rewind to a moment you probably know all too well. Maybe you bought a stock and it skyrocketed. You felt like a genius. Maybe you even told a few friends, feeling proud of your smart pick. Then maybe you held on to it too long and it tanked. That pit in your stomach, that's regret. But did you sell right away, or did you hold on, hoping it would bounce back just so you didn't have to admit you were wrong? This is the emotional battlefield of pride and regret. Two powerful forces that shape the way we invest more than we like to admit. In this chapter, John Nofsinger unpacks how these emotions can push us into poor decisions. Not because we're foolish, but because we're human. Pride, first off, is that feeling of satisfaction we get when things go our way, especially when we think it's because of our own smarts. Investors love that feeling. Who wouldn't? When our portfolios rise, we pat ourselves on the back. We tell ourselves, I knew this company was going to do well, and it boosts our confidence. But here's the catch. That pride can quickly become a trap. Nofsinger highlights how pride keeps us from selling losers. Think about it. When an investment is losing value, selling it means admitting you were wrong. And nobody likes to do that. So what do? We hold on. We justify. It's just a dip. It'll come back. This stock has potential. That prideful refusal to admit a mistake often leads to even greater losses. Then there's regret, one of the most paralyzing emotions in investing. It's that gnawing, aching feeling when we realize we missed out on a great opportunity or made a terrible decision. Nofsinger explains that investors often fear regret so much that it keeps them from making any decision at all. They get stuck in analysis paralysis, scared to make a move in case it turns out badly. One powerful story in the chapter involves a man who had the chance to invest in Amazon early on. He didn't, and he's been haunted by it ever since. Now, every time he makes a financial decision, he hesitates. What if I'm wrong again? That past regret freezes him in the present. Regret doesn't just affect our memories, it shapes our future. We might avoid taking new risks or make overly conservative choices just to protect ourselves from ever feeling that pain again. Ironically, this often means we miss good opportunities because we're living in the shadow of past mistakes. Another common behavior tied to these emotions is loss aversion, a fancy way of saying we hate losing money more than we like gaining it. In fact, research shows that the pain of a $100 loss hurts twice as much as the joy of a $100 gain. This makes us behave in really odd ways. Let's say you have two stocks. One has gone up and one has gone down. Logic says, sell the loser and let the winner run. But pride tells you to lock in the gain so you feel smart. And regret tells you not to sell the loser, because that would mean admitting a mistake. So what do? You sell the winner and keep the loser. That, right there, is the wrong move. But it's emotionally the easier one. Nofsinger introduces a concept from psychology called prospect theory, developed by Nobel Prize winners Daniel Kahneman and Amos Tversky. This theory explains how people make decisions when faced with risk, and it shows how we tend to make irrational choices just to avoid feeling regret or admitting we were wrong. One example: investors are more likely to take big risks to avoid realizing a loss than to earn a gain. So instead of cutting their losses and walking away, they double down, hoping to win it back. It's the same behavior you see at a blackjack table when someone keeps betting more after every loss. This behavior isn't limited to individual investors either. Nofsinger shows how professional fund managers fall into the same emotional traps. In fact, studies show that many fund managers are reluctant to sell losing investments in the final quarter of the year because they don't want to report poor performance. It's pride again, this time on Wall Street, but it's not all doom and gloom. Nofsinger also shares strategies to help us escape this emotional loop. First, recognize the pattern. Just being aware that pride and regret influence your decisions is a huge first step. Next time you're hesitating to sell a losing stock, ask yourself, am I holding this because it's a good investment or because I don't want to admit I was wrong? Second, use rules instead of emotions. Create a system. For example, set a stop loss at 10% below your purchase price. If the stock drops that far, sell it. No questions asked. This removes pride and regret from the equation. Third, practice mental accounting. It might seem silly, but pretend you're starting from scratch with your portfolio. Ask yourself, if I had this cash today, would I buy this investment again? If the answer is no, that's a clue. It might be time to let it go. Also, log your decisions in a journal. Write down why you bought something and what your exit plan is. That way, when emotions hit, you can go back to your original logic and not just act on impulse. Finally, give yourself permission to make mistakes. Regret is powerful, but it's also universal. Every investor, even the best, has a list of things they wish they did differently. What separates successful investors is that they learn from their regret instead of being controlled by it. To wrap it up, pride and regret are two sides of the same coin. One puffs us up, the other pulls us down. But both can cloud our judgment if we don't keep them in check. Recognizing when these emotions are creeping into our financial decisions is the key to avoiding self-sabotage, because in the world of investing, the goal isn't to always be right. It's to make better decisions over time. And that starts with humility, honesty, and a willingness to say, I was wrong, and that's okay. Chapter 4, Risk Perceptions. You and your neighbor both have $10,000 to invest. You decide to put it in a conservative index fund. Your neighbor, however, jumps into cryptocurrency. A few months later, he's doubled his money, or lost half of it. Either way, the question isn't just who made more. It's how each of you perceived the risk. That's what this chapter explores, the gap between actual risk and perceived risk. And as John Nofsinger points out, that gap can cause even the smartest investors to act irrationally. Let's start with something simple. Risk, in financial terms, usually means volatility, how much an investment's value can fluctuate over time. Stocks are considered riskier than bonds because they can swing wildly in price. But for the average person, risk doesn't feel like math. It feels like fear. Fear of losing money, missing out, or looking foolish. Nofsinger explains that while traditional finance focuses on objective risk, things like standard deviation and beta, behavioral finance digs into how people feel about those risks. And surprise, feelings don't always match reality. For instance, if someone just went through a market crash, say the 2008 financial crisis, their perception of risk is going to be sky high, even if the market has stabilized. That's because humans suffer from what psychologists call the availability bias. We give more weight to things that are recent, vivid, or emotionally charged. Think about it this way. Plane crashes are rare, but they make the news. So many people feel flying is riskier than driving, even though statistically it's not. The same thing happens with investing. If the last thing you heard was someone losing big in stocks, your brain lights up with caution, even if the odds are actually in your favor long term. Another emotional lens that distorts risk is framing. If someone tells you that a fund has a 90% chance of success, you might feel great about it. But if they tell you there's a 10% chance of failure, your stomach drops. Same data, different reaction. That's the power of framing. How information is presented changes how we perceive the risk involved. Nofsinger gives a great example of this with retirement investing. People often shy away from stocks in their 401ks because they feel risky, too many ups and downs. But over a 30-year time frame, those ups and downs average out, and stocks generally outperform safer investments like bonds or CDs. The problem isn't the actual risk, it's the perceived risk based on short-term thinking. He also dives into loss aversion again here, a concept introduced earlier but central to how we experience risk. Losing $100 hurts more than gaining $100 feels good. Because of that, many investors shy away from even moderate risks, missing out on potential gains. They'd rather avoid pain than pursue reward. But here's the twist. Our perception of risk isn't fixed. It changes depending on mood, recent experiences, and even the environment. Let's say you just got a raise or tax refund. You might feel flush, optimistic, and more open to risk. But if you just had a big, unexpected expense or watched a friend lose money in a bad investment, suddenly risk feels terrifying. That's why timing matters. The same person might make totally different choices a week apart, based on how they're feeling. One of the more fascinating points Nofsinger makes is how social influence shapes our perception of risk. If everyone around you is excited about a certain investment, think meme stocks like GameStop, it starts to feel less risky. If everyone's doing it, it must be okay, right? This is herding behavior, and it often leads people to jump into investments they barely understand because the fear of missing out, FOMO, is stronger than their sense of caution. Of course, the reverse is true too. If the news is filled with doom and gloom, or your peers are panicking, then even safe investments start to feel scary. In both cases, perception overrides facts. Nofsinger also notes how people overestimate rare risks and underestimate common ones. For example, investors may be terrified of a market crash, something that happens occasionally, but ignore the very real constant risk of inflation slowly eroding their savings. Why? Because crashes are dramatic, visible, and memorable. Inflation is slow and sneaky. So what can you do to manage your perception of risk and make smarter decisions? First, educate yourself. The more you understand how different investments actually work, historically and statistically, the more you can separate feelings from facts. Data doesn't eliminate fear, but it puts it in perspective. Second, zoom out. Don't judge an investment by what happens in a day, a week, or even a year. Look at the long-term track record. Investing isn't a sprint, it's a marathon. A bad quarter doesn't make something risky. It makes it normal. Third, limit emotional decision-making. One of the best ways to do this is automation. Contribute regularly to your investments regardless of what the market's doing. This set-it-and-forget-it strategy helps you avoid reacting to perceived risk in the moment. Fourth, diversify. Diversification doesn't just reduce actual risk. It reduces the emotional pressure of having all your eggs in one basket. When one investment dips, others might rise, giving you more stability and confidence. And finally, talk it out. Sometimes just discussing your fears and instincts with a trusted advisor or even a knowledgeable friend can help reset your perception. They might not change the facts, but they can help you reframe the situation. At the heart of this chapter is a powerful message. Risk is not just something out there in the market. It's something inside you, shaped by your emotions, memories, and social surroundings. And if you don't understand how your brain views risk, you're likely to make decisions based on fear instead of strategy. So the next time you're staring at a scary headline or watching your portfolio dip, Take a breath. Ask yourself, is this risky or just feeling risky? Because in investing, mastering risk doesn't just mean understanding numbers. It means understanding yourself. Chapter 5. Decision Frames. Imagine you walk into a store looking for a jacket. You see two signs. One says 20% off. The other says buy now and save $20. Both offers are the same, but odds are one feels more appealing to you. Why? It's all about the frame. In this chapter, John Nofsinger introduces us to a fascinating concept in behavioral finance: decision framing. It's the invisible lens through which we interpret financial choices. And that lens can drastically change our behavior, even when the facts stay the same. Framing is everywhere. It's not about what you're deciding, it's about how that choice is presented to you. The way options are worded, structured, or even the emotions attached to them can lead us down totally different paths. Take this classic example from psychology. Imagine a disease is expected to kill 600 people. Program A will save 200 people. Program B has a 1/3 chance all 600 will be saved, and a 2/3 chance no one will be. Most people pick A. It feels safer. Now, frame it differently. Program A means 400 people will die. Program B still has the same odds. Suddenly, more people choose B, because now it's about avoiding certain loss. Same math, different decisions. That's framing at work. In investing, framing shapes how we interpret risk, opportunity, and even our own past decisions. Let's talk about gains versus losses. If you hear that your portfolio went up 5%, you feel great. But if someone says you could have earned 10%, but you only got 5%, suddenly that same outcome feels like a letdown. The outcome didn't change, just the way it was framed. This leads to one of the biggest ideas in this chapter. Losses loom larger than gains. We've seen this before in earlier chapters, but framing explains why we act on it. We react more strongly when something is framed as a loss than when it's framed as a gain, even if the real value is identical. Now imagine you're deciding whether to sell a stock. If it's gone up, your frame might be locking in gains. That feels good, satisfying. But if it's gone down, you're realizing a loss. That feels painful. So even though selling a loser might be the smart move, you hesitate. Why? Because you framed the act of selling as accepting defeat. Nofsinger explains how we mentally separate money into different categories based on how it's framed in our minds. For example, a $1,000 tax refund feels like extra money, even though it's technically just your money being returned. Because of the frame, people often spend refunds more freely than regular income. This behavior doesn't come from financial logic. It comes from the way we label and emotionally perceive money. Even investing in safe versus risky assets is heavily influenced by framing. If a product is marketed as guaranteed or secure, it feels emotionally comforting, even if the returns are poor. On the flip side, if something is framed as having potential for high reward, our imagination takes over, often ignoring the very real risks. One powerful story in the chapter involves retirement savings. Nofsinger describes how framing affects people's decisions about Social Security. If claiming benefits early is framed as getting your money now, many people jump at it, even if waiting would yield much higher long-term payouts. But if it's framed as missing out on thousands of dollars later, people tend to pause and reconsider. Same decision, totally different reactions based on the framing. There's also an important point about default options. In countries where citizens are automatically enrolled in retirement plans and have to opt out, participation rates are sky high. But in countries where they have to opt in, rates are much lower. The frame, being in versus being out, changes behavior dramatically, even though people can freely choose either way. Nofsinger also discusses how framing can reinforce emotional biases. Say you're told that a fund manager outperformed the market 3 years in a row. That sounds impressive. But what if you're told that same manager underperformed 6 out of the last 10 years? Now you're skeptical. Again, same data, different frame, totally different impression. Marketers and financial advisors know this and use it. A fee of just 1% annually sounds harmless, but frame it as losing 20% of your total gains over a decade, and it starts to sting. That's why, as investors, we need to train ourselves to look beyond the frame. So what can we do to make better decisions in a world full of clever framing? First, pause and reframe yourself. If an offer feels too good or too bad, flip it. Ask, what's the same information but presented differently? If someone says you're losing 5% annually, reframe it as keeping 95%. That simple mental shift can reduce emotional reactions and lead to more rational choices. Second, seek neutral language when evaluating financial products. Strip out the fluff. Instead of guaranteed return, ask, what's the actual interest rate? Instead of potential gains, ask, what's the historical risk profile? Third, be aware of your own internal frames. Are you labeling certain money as mad money or bonus cash? Try treating every dollar equally. Money is money, no matter where it came from. The source doesn't change its value. Fourth, challenge emotional labels. If you're reluctant to sell a bad stock because it's a loser, reframe it as freeing up cash for a better opportunity. That new frame can help you cut ties with underperforming assets and make smarter decisions. Finally, practice long-term framing. Instead of thinking this investment dropped 10% this month, ask, what's the trend over 5 years? Short-term frames often cause panic, but stepping back helps you see the bigger picture. Nofsinger closes the chapter with a powerful reminder. You can't escape framing. It's part of how the brain works, but you can train yourself to recognize it. The goal isn't to eliminate emotional responses. It's to understand how frames shape them and to create better ones on purpose, because when you control the frame, you control the focus. And in investing, where emotions run high and consequences are real, that control can mean the difference between reacting to fear and responding with wisdom. Chapter 6. Mental Accounting. Let's say you're walking into a movie theater. You've already bought your $12 ticket online, but as you reach into your pocket, you realize you lost the ticket. Would you spend another $12 for a new one? Now imagine a different scenario. You haven't bought the ticket yet, but you arrive at the theater and realize you lost $12 in cash on the way in. Do you still buy the ticket? Most people say no to the first, but yes to the second. Same $12, same end result. Totally different behavior. Why? Because of mental accounting. In this chapter, John Nofsinger introduces us to this powerful mental shortcut. Mental accounting is how we psychologically separate our money into different buckets, and how those labels shape the way we spend, save, and invest. It's not rational, it's not even consistent, but it's very human. Let's break it down. In pure financial theory, all money is the same. $1 from your paycheck is no different than $1 from your birthday card or your tax refund. But in our minds, that's not how it works. We treat money differently based on where it comes from, what we plan to use it for, or even how it makes us feel. Think about the found money effect. If you get a $500 bonus at work, chances are you'll be more likely to spend it on something fun, a new TV, a weekend trip. But if you get the same $500 through regular wages, you might put it toward bills or savings. Again, same dollar value, but framed differently in your mental accounts. Nofsinger shares stories of investors who do this all the time, like the guy who keeps safe money in one account and fun money in another. Or someone who refuses to sell a stock at a loss, even though reinvesting the money elsewhere would make more sense. Why? Because that money is tied to a specific goal in their mind, and touching it feels wrong. There's even an interesting twist when it comes to gambling or speculative trading. People often justify risky behavior when they're playing with house money, meaning profits they've already made. Since it's not part of their original capital, they feel freer to risk it. But in truth, that money is just as real, and losing it hurts just as much once it's gone. One of the most common examples of mental accounting is how we treat debt versus savings. Many people carry high-interest credit card balances while keeping money in low-interest savings accounts. From a mathematical perspective, that's a terrible strategy. You're paying 20% interest and earning 1%. But emotionally, that savings feels like a security blanket. It's a do-not-touch fund. Nofsinger explains how this kind of thinking is especially problematic when it comes to investing. People may be very aggressive with their 401k accounts, but extremely cautious with their taxable brokerage accounts, even though the money in both is for retirement. Why? Because the labels we assign. This is retirement money. This is emergency money. This is play money. Create psychological silos that don't always align with financial reality. Another key area where mental accounting plays out is budgeting. People often create spending categories and like $300 for dining out, $100 for clothes, and they stick to those categories rigidly. That's not necessarily bad, but it becomes irrational when people overspend in one area and refuse to move leftover funds from another. For example, someone might have $50 left in their entertainment bucket, but go into credit card debt to pay for groceries. That's mental accounting leading to real-world problems. There's also the sunk cost fallacy, which is closely tied to mental accounting. Let's say you paid $100 for a concert ticket, but on the night of the show, there's a blizzard. You don't want to go, but you force yourself. I already paid for it, but the money is gone. The rational choice would be to stay safe and warm. The mental accounting trap. You feel like you owe it to the ticket. Nofsinger illustrates how even smart investors fall into this trap with stocks. They may hold on to losing investments simply because they've already put money into them. They say things like, "I'll sell when I break even." But that's not strategy. That's pride and a flawed mental ledger. So what can you do to manage your mental accounts? Or better yet, take control of them. First, recognize your buckets. Start by noticing how you categorize money in your life. Do you treat bonuses differently than paychecks? Are you keeping emergency savings while paying 18% interest on debt? Awareness is step one. Second, reframe all dollars as equal. Try this exercise. Take all your cash, savings, and investments, and pretend they're in one big pile. Now ask, if I were starting fresh today, would I still allocate this money the same way? That perspective can help you correct imbalances. Third, use mental accounting to your advantage. Yes, it can lead to irrational behavior, but it can also help you build better habits. For example, you might create a guilt-free spending account for fun money or a vacation fund to avoid dipping into long-term savings. The key is to be intentional with your categories, not just emotional. Fourth, beware of house money syndrome. Just because you made money on a trade or investment doesn't mean the next dollar is any less valuable. Every financial decision should be based on current facts, not emotional labels. Fifth, don't let mental accounting delay smarter moves. If you're holding a losing stock because it's down too much to sell, or keeping a low-yield account because that's my emergency money, Consider whether reallocating that money could serve you better. And finally, keep emotion and math in balance. Mental accounting isn't all bad. In fact, it can protect you from impulse spending or help you stay disciplined. The problem arises when your mental categories stop you from making rational decisions. Nofsinger ends the chapter with a simple but powerful idea. Money doesn't care where it came from. It doesn't know it's fun money or serious money. That's all in your head. And the better you understand those mental labels, the more you can align your financial behavior with your actual goals, not just your emotions. Because mastering your money isn't just about budgeting or investing. It's about seeing money for what it truly is, a tool, not a trophy, not a secret stash, just a tool. And the better you get at using it without the fog of mental accounting, the better off you'll be. Chapter 7. Forming portfolios. You've probably heard the phrase, "Don't put all your eggs in one basket." Sounds simple, right? Yet, when it comes to investing, most people still drop all their eggs, emotionally and financially, into just a few baskets. In this chapter, John Nofsinger explores how investors actually go about building their portfolios, and how psychology often leads them to create collections of investments that look diverse but really aren't. Let's start with the ideal. In traditional finance, building a portfolio is about optimizing risk and return. It's mathematical, logical, and, in theory, straightforward. You figure out how much risk you can handle, then invest in a mix of assets, stocks, bonds, real estate, cash, that match your goals and tolerance. But in the real world, that's not how most people do it. Nofsinger opens with the concept of naive diversification. It sounds fancy, but it's actually quite common and kind of flawed. Imagine a 401k plan with 5 funds. You don't know much about any of them, so you just put 20% in each. That feels diversified, but if 3 of those 5 funds are heavily invested in tech stocks, you've accidentally overloaded your portfolio with one sector without even realizing it. This kind of decision-making is everywhere. People often equate different choices with diversification, even if those choices overlap significantly. It's like ordering 5 different meals at a buffet, and then realizing they all come with mashed potatoes. The variety was an illusion. Nofsinger points out that even professional investors fall into this trap. Pension funds, mutual funds, hedge funds, they're all managed by humans with emotions, biases, and blind spots. And while their portfolios might be more complex, they're not immune to these mental missteps. One key psychological factor in portfolio construction is familiarity. People tend to invest in what they know, companies they recognize, industries they work in, or stocks from their home country. This is called home bias. For example, a U.S. investor might heavily favor domestic companies, even though international diversification could reduce risk and improve returns. The same thing happens on a smaller scale. A person working at Apple might invest their retirement savings heavily in Apple stock because they believe in the company. But now their job and their investments are tied to the same place. If Apple stumbles, they're in double trouble. Familiarity feels safe, but in investing, safety is often an illusion. Just because you know something doesn't mean it's less risky. Another problem? Overcomplicating portfolios. Investors sometimes add too many funds or individual stocks, thinking more means better. But if all those funds invest in similar assets, say large-cap U.S. companies, then your diversification is just window dressing. You've built a closet full of different suits that are all the same color. Nofsinger brings in a useful term here, correlation. When 2 assets move in the same direction, they're highly correlated. If your portfolio is filled with assets that are tightly correlated, like 5 tech ETFs, then a downturn in that sector will drag down everything. True diversification means mixing assets that don't move together, like stocks and bonds or U.S. and emerging market equities. The goal of diversification isn't just variety, it's balance. You want some assets that zig while others zag. That way, when one part of your portfolio struggles, another part can offset the damage. Now, here's where psychology gets even trickier. People love winners. We're naturally drawn to funds or stocks that have performed well recently. Nofsinger calls this chasing performance, and it's one of the fastest ways to destroy a portfolio. Say, Fund A returned 25% last year, and Fund B returned 5%. You move your money from B to A, assuming the trend will continue. But in reality, investments often revert to the mean. That means this year, Fund A could cool off, and Fund B might bounce back, and you've bought high, sold low, and lost ground. Investors also tend to ignore the importance of rebalancing. Let's say you start with a portfolio that's 60% stocks and 40% bonds. After a few good years for stocks, that ratio might creep up to 75 to 25. Now you're taking on more risk than you originally intended, without even realizing it. Rebalancing means selling some of the high-performing assets and reinvesting in lower-performing ones to restore your target allocation. It sounds counterintuitive. Sell the winners and buy the losers, but that's exactly how long-term investors manage risk and lock in gains. Yet very few people do it. Why? Because it feels wrong. Again, emotion overrides logic. So how can we build better portfolios while managing the emotional traps along the way? 1. Know your goals and your time horizon. Are you investing for retirement 30 years from now or buying a house in 5? Your asset mix should reflect when you'll need the money and how much risk you can afford to take. 2. Think in terms of categories, not just names. Don't judge a fund by its brand or title. Dig into what it holds. Is it growth or value, large cap or small cap, domestic or international? Check for overlap. 3. Use tools like target date funds if you're unsure. These automatically adjust your asset mix based on your retirement year. They're not perfect, but they're often better than guessing or overthinking. 4. Diversify across asset classes. This includes not just stocks and bonds, but also cash, international equities, and maybe even real estate or commodities. The more uncorrelated assets you include, the smoother your ride. 5. Rebalance regularly and automatically if possible. Whether it's quarterly, annually, or based on percentage thresholds, rebalancing helps you stick to your strategy and avoid drifting into risky territory. 6. Avoid chasing returns. Past performance is not a reliable predictor of future gains. Focus on long-term fundamentals, not short-term headlines. And maybe most importantly, 7. Keep it simple. A good portfolio doesn't need to be flashy or complicated. In fact, some of the best performing portfolios are downright boring. Warren Buffett once advised the average investor to put 90% in a low-cost S&P 500 index fund and 10% in short-term government bonds. Simple, effective, emotion-free. Nofsinger ends the chapter with a challenge. Take a hard look at your portfolio. Are you truly diversified? Or have your choices been shaped by familiarity, recent performance, or emotional comfort? Because a smart portfolio isn't just about what you have. It's about what those choices say about how you think. And if you want to build wealth over the long haul, you have to build a portfolio that's stronger than your biases. That's the real foundation of smart investing, not just numbers on a spreadsheet, but self-awareness in action. Chapter 8, Representativeness and Familiarity. You meet someone who's polite, organized, and loves spreadsheets. Without even thinking, you assume they're an accountant. Why? Because they fit the stereotype. That's representativeness bias. It's a mental shortcut that helps us make quick judgments. But in the world of investing, it can lead us straight into trouble. In this chapter, John Nofsinger takes us deep into two dangerous psychological tendencies that shape investor behavior: representativeness and familiarity. Both are subtle, both feel logical, but both can cause serious financial mistakes if you don't learn to spot them. Let's start with representativeness. This is our brain's tendency to judge the likelihood of something based on how closely it resembles something else, even when the resemblance is superficial or irrelevant. For example, say you're evaluating two companies. Company A is a small tech startup based in Silicon Valley with young founders and a sleek website. Company B is a 30-year-old manufacturer based in the Midwest with a boring name and plain branding. Many investors would instantly feel more excited about Company A, not because they've analyzed financials, but because it feels like the kind of company that succeeds big. It represents success in our minds. It fits the mold of what we think a winning investment looks like, just like the polite spreadsheet lover felt like an accountant. Nofsinger explains how this bias leads us to overestimate the chances of dramatic outcomes. When we hear about a startup becoming the next Amazon or Tesla, we start seeing that potential everywhere, even in companies that are nothing like them. It also causes us to chase recent winners. If a mutual fund has outperformed the market 3 years in a row, we assume it's a good fund and expect that trend to continue. But past performance doesn't guarantee future results. And often, the hottest funds revert to the mean, delivering disappointing returns after their streaks. Representativeness also fuels market bubbles. Remember the dot-com boom? Investors poured money into tech companies simply because they looked successful. Many had no profits, shaky business models, or even revenue, but they fit the mental image of fast-growing modern businesses. And so, people invested, and when the bubble burst, billions evaporated. Now let's talk about familiarity bias. This is our tendency to prefer things we know and avoid things that feel unfamiliar, even if the unfamiliar option is objectively better. It's a deeply human trait. We stick with restaurants we've been to before. We buy brands we've seen on TV. And in investing, we lean toward companies we recognize, industries we work in, or countries we live in. That's home bias in action. A U.S. investor might hold 90% of their portfolio in American stocks, even though international diversification would reduce risk and potentially improve returns. Why? Because American companies feel familiar, comfortable, trustworthy, but that comfort is deceptive. Nofsinger tells a story about investors in Japan during the 1990s. After decades of explosive growth, Japanese stocks felt like the safest bet, and many investors loaded their portfolios with domestic companies. Then came Japan's lost decade, an extended period of stagnation and decline. Those who stayed overly local got crushed. Familiarity bias can show up in other ways too. People may overload their portfolios with companies they work for. It feels like loyalty, but it's risky. If your job and investments both depend on the same company, you're doubling down on one outcome. Another trap. Investors may avoid asset classes they don't understand. Bonds? Too boring. Emerging markets? Too unpredictable. Cryptocurrency? Too confusing. So they stick with what they know, usually U.S. large-cap stocks, and miss out on opportunities for real diversification. And then there's the influence of media. Companies you hear about all the time, like Apple, Amazon, or Tesla, feel more familiar. That doesn't mean they're better investments, but they feel safer. You've seen their logos, used their products, watched their CEOs on YouTube. That comfort gives you a false sense of security and might lead you to overconcentrate your portfolio. So what can you do to protect yourself from these sneaky biases? 1. Recognize the stereotypes. When you catch yourself thinking, "This company looks like a winner," pause. Ask yourself, why does it seem that way? Are you judging based on financials or just gut feeling and surface details? 2. Fight the urge to chase trends. Just because an asset or fund has done well recently doesn't mean it will continue. Performance streaks often fade. Dig deeper. What's driving the returns? Is it sustainable? 3. Diversify intentionally. Don't let comfort guide your choices. Look at your portfolio by region, sector, and asset class. Are you overly concentrated in one area just because it's familiar? Expand your reach thoughtfully, not recklessly. 4. Learn before you leap. If something feels unfamiliar, like international bonds or emerging market funds, don't automatically avoid it. Do some homework. Often, unfamiliarity fades with a little education. 5. Use data, not emotion. When evaluating investments, look at real metrics: price-to-earnings ratios, revenue growth, debt levels, cash flow. Don't rely on how cool a company seems or how often it shows up in the news. 6. Avoid overconfidence in your circle of competence. Just because you work in an industry or use a company's products doesn't mean you have an edge. Many employees have lost fortunes betting on their own companies. Always consider risk. Nofsinger emphasizes that representativeness and familiarity aren't inherently bad. They're mental shortcuts, and sometimes shortcuts help us make quick decisions. But in investing, speed isn't usually your friend. These biases make us feel like we're being smart, when in reality, we're just being comfortable. And the market doesn't reward comfort. It rewards discipline, diversification, and clear-eyed thinking. So the next time you find yourself drawn to a stock because it just feels like a winner, stop. Ask yourself, am I investing in the company or in the idea of the company? Because in the long run, smart investing isn't about chasing what feels right. It's about challenging your assumptions and building a portfolio that's stronger than your biases. Chapter 9. Social Interaction and Investing. Picture this. It's a summer BBQ. You're flipping burgers, drink in hand, chatting with friends. Someone casually mentions they just made a killing on a new stock. Something about a biotech company or an EV startup. Suddenly your ears perk up. Maybe you even pull out your phone and buy a few shares. After all, if they made money, why shouldn't you? That right there is social influence in action. And in this chapter, John Nofsinger reveals just how deeply our investment decisions are shaped by the people around us, our friends, family, co-workers, and even total strangers online. You might think investing is a solo activity, but it's not. It's social. We observe others, take cues from them, and often copy what they're doing, sometimes without even realizing it. Behavioral finance calls this herding behavior, and it can be both comforting and dangerous. Nofsinger starts by laying out the basic idea. When we don't know what to do, we look to others. It's a natural human instinct. From an evolutionary standpoint, following the group kept us alive. If everyone ran from a rustle in the bushes, you ran too, just in case. Better safe than sorry. But in the stock market, following the crowd can lead us right off a cliff. He dives into a classic study where people were asked to guess the number of jelly beans in a jar. Individually, their answers were all over the place. But the average of all the guesses? Surprisingly accurate. That's the wisdom of crowds, a phenomenon that can work well when people act independently. The problem arises when people stop thinking for themselves and just mimic each other. That's when herding takes over. Instead of making decisions based on facts, people make decisions based on what others are doing. It becomes a feedback loop. And that's how bubbles form. Nofsinger gives the example of the housing market in the mid-2000s. Everyone seemed to be buying homes, even flipping them for profit. You probably heard stories of ordinary people making tens of thousands in months. That social buzz made everyone want in. It felt like a sure thing. Then, crash. Why did people ignore the warning signs? Because when everyone around you is getting rich, it's hard to sit on the sidelines. Not only are you missing out on gains, you're missing out on belonging. That's a powerful force. He brings up social proof, the idea that if lots of people are doing something, it must be the right thing. This works in product reviews or restaurant choices, but not in the stock market. Just because thousands of people are buying a stock doesn't mean it's a good investment. It might just mean the hype train is full. Nofsinger also tackles overconfidence by association. When a friend tells you about their investment win, they sound smart, confident, and that confidence rubs off on you. You trust them. You want to replicate their success, and you forget that they might have just gotten lucky. Another trap? Selective storytelling. People love to share their wins, but rarely their losses. So if you're surrounded by people constantly talking about successful trades, you might assume everyone's making money. That's a false picture. It creates FOMO, the fear of missing out, and pushes you to make rushed, risky decisions. Now, in the age of Reddit, Twitter, TikTok, and Discord, the power of social investing has exploded. Meme stocks like GameStop and AMC weren't just about financials, they were movements powered by online communities. Nofsinger doesn't dismiss the power of these groups, but he warns that when investing becomes about belonging to a tribe instead of building wealth, it's easy to lose track of the fundamentals. He shares research that shows people are far more likely to invest in stocks recommended by friends than in ones found through independent research. There's nothing inherently wrong with that, but it becomes dangerous when the trust in the source replaces due diligence. So how can you stay grounded in a world full of noise, hype, and social pressure? 1. Build your own framework. Before listening to anyone else, create your own investing strategy. What's your time horizon, your risk tolerance, your goals? If an investment doesn't fit into that framework, no matter how hot it is, pass. 2. Filter the noise. Not every tip is worth acting on. When someone tells you about a great trade, ask questions. What's the company's long-term outlook? How volatile is it? Are they investing 5% of their portfolio or betting the farm? Often you'll find they're gambling, not investing. 3. Don't chase conversations. Chase consistency. Great investing isn't exciting. It's not about cocktail party stories. It's about slow, steady, boring decisions made over time. That doesn't make for flashy social talk, but it does build real wealth. 4. Understand your emotional triggers. Are you acting because you truly believe in a stock or because you feel left out? Are you afraid of missing the next big thing? Pause. Reflect. If the motivation is social pressure, it's probably not a wise move. 5. Educate, don't imitate. If a friend brings you an idea, research it. Look at the numbers, the risks, the fundamentals. Turn a social lead into a personal conviction. If it passes your tests, then maybe it's worth considering. 6. Keep some things private. Not every financial decision needs to be shared or crowdsourced. The more you talk about your investments, the more you invite social feedback, and that can mess with your clarity. Nofsinger isn't saying you should ignore all social input. There's wisdom in crowds, when the crowd is diverse, informed, and independent. But when it becomes an echo chamber, it stops being wise and starts becoming dangerous. In the end, the smartest investors are often the quietest. They tune out the hype, skip the gossip, and stick to their plan. They know that investing is personal, and that following the crowd is rarely the road to financial freedom, because in a world full of voices shouting, "Buy this and sell that," the most valuable voice is still your own, when it's guided by reason instead of social reaction. Chapter 10. Emotion and Investment Decisions. Imagine you've just watched your carefully chosen investment plummet 15% in a single day. Your heart races, you feel sick, your brain screams, "Sell it now before it drops more." You know you're supposed to think long-term, but all you feel is panic. That's emotion taking over. And in this chapter, John Nofsinger shows us just how powerful and dangerous emotions can be in investing. Let's get one thing straight. Emotions aren't bad. They're essential to being human. They help us experience joy, caution, excitement, and love. But when it comes to financial decisions, emotions are often the enemy of logic. They cloud judgment, shorten our time horizon, and tempt us into doing exactly the wrong thing at the wrong time. Nofsinger begins by breaking down the two types of emotions that impact our decisions. Anticipatory emotions, like hope, excitement, or fear, that influence us before we make a choice. Reactive emotions, like regret, disappointment, or relief, that hit us after we've made one. Both types shape the way we buy, hold, and sell investments, and both can sabotage even the most carefully crafted financial plan. Let's look at fear first. Fear is perhaps the most primal, powerful emotion in investing. When the market drops, even a little fear makes it feel like the sky is falling. Your rational mind knows that markets go up and down, but fear isn't rational. It triggers the fight or flight response. Investors often sell when they're scared, and usually at the worst possible moment. The stock dips, fear spikes, they panic sell at the bottom. Then, when the market recovers, they're too scared to get back in. They miss the rebound, and the cycle repeats. On the flip side is greed, the emotion behind bull markets, bubbles, and bad timing. When prices are rising and people are making money fast, greed tells you, get in now or you'll miss out. It blinds you to risk, fuels reckless bets, and creates a dangerous overconfidence. Nofsinger reminds us of the dot-com and housing bubbles, times when investors weren't thinking clearly but emotionally. They weren't asking, does this make sense? They were asking, how do I get in on this before it's too late? He shares a striking example of two investors. One sells when the market is down 10% because he feels like it'll get worse. Another holds despite the fear because her plan is long-term. A year later, the market rebounds. One is recovering, the other is still on the sidelines, frozen by regret and shame. That brings us to another key emotion, regret. Regret is powerful. It lingers. It shapes future behavior, sometimes in healthy ways, but often in paralyzing ones. If you regret buying a stock that tanked, you might become overly cautious next time, or you might swing the other way, trying to make back your losses with risky trades. What Nofsinger calls emotional revenge investing. There's also pride, the need to prove we were right. This keeps people holding on to bad investments, hoping they'll bounce back just so they won't have to admit they made a mistake. It's not strategy, it's ego. Even relief can mess with our logic. Selling a volatile stock might feel good in the moment. No more stress. But if that decision was driven by short-term discomfort instead of a long-term plan, that relief is fool's gold. Nofsinger also dives into the biology behind these emotions. When we anticipate a gain, our brains release dopamine, the reward chemical. It feels great. We get addicted to that high. But when we lose money, cortisol and adrenaline flood our system. It's literally a physical stress response. That's why financial loss hurts, not just mentally, but physically. Understanding this biological element is key, because when you realize your emotions are part of your hardwiring, you stop blaming yourself and start building systems to protect yourself. So what can we do to manage emotions? instead of letting them manage us. 1. Have a written plan. It sounds boring, but it's powerful. A clear, written investment strategy gives you something to fall back on when emotions are high. If your plan says hold through volatility or don't invest more than 10% in speculative assets, then follow it, especially when you don't feel like it. 2. Automate your investing. Set up automatic contributions to your 401k, IRA, or brokerage account. This takes emotions out of the equation entirely. No decisions, no drama, just steady investing. 3. Practice emotional distancing. Nofsinger suggests looking at your portfolio less often, especially during downturns. Checking your investments every day can increase anxiety and lead to emotional decisions. Long-term investors don't need daily updates. 4. Journal your decisions. Before making an investment, write down why you're doing it. Then, months later, review that reasoning. Were you being thoughtful or emotional? This helps you spot patterns and break bad habits. 5. Avoid media overload. Financial news thrives on emotional language. Crash, boom, panic, soar. The goal is ratings, not reason. Be selective about what you watch, read, and trust. If it makes your heart race, it's probably not helping. 6. Talk to someone. Whether it's a financial advisor or a level-headed friend, talking about your feelings during volatile markets can help calm you down. Emotions are normal, but they shouldn't be secrets. 7. Embrace discomfort. Markets will drop. Investments will lose value. This is normal. The key is expecting discomfort and preparing for it, not reacting to it when it happens. Nofsinger emphasizes that the goal isn't to eliminate emotion. That's impossible. We're not robots. The goal is to recognize emotion and separate it from action. Feel fear, but don't sell in fear. Feel greed, but don't buy in greed. Feel regret, but don't let it control your next move. Because in investing, emotion is inevitable, but emotional decisions are optional. In the end, your financial success isn't just about knowledge or analysis. It's about managing the messy human side of money. That means building a system that protects you from yourself, a system rooted in patience, awareness, and self-control. Because when emotion shouts, "Do something now," wisdom whispers, "Stick to the plan." Chapter 11. Self-control and decision-making. Imagine walking into a store with the intention of buying a basic pair of running shoes. But as you browse, something flashy catches your eye. Limited edition sneakers with a premium price tag. You hesitate, you do the math, but your heart's already sold. Before you know it, you're at the checkout, $200 lighter. That, right there, is a self-control failure. And it's just as common, if not more dangerous, in investing. In this chapter, John Nofsinger explores one of the most critical psychological hurdles in personal finance, the ongoing battle between short-term temptations and long-term goals. It's not a lack of knowledge that derails most investors. It's a lack of self-control. Nofsinger starts with a simple truth. We know what we should do. We should save consistently, avoid impulsive trades, rebalance our portfolios, and stick to our plans. But knowing isn't doing. The gap between intention and action, that's where self-control lives, and often fails. He introduces a key concept from behavioral science: time inconsistency. That's when our preferences change over time, not because the facts change, but because we do. For example, you plan to start investing more aggressively next month, but when next month comes, you delay again. Why? Because the future always feels distant and the present always feels urgent. It's the same logic behind why people postpone retirement contributions to next year or cash out a 401k to fund a vacation. The future version of ourselves is disciplined, wise, and patient. But the present version, he wants comfort. She wants excitement. And so we prioritize immediate gratification over long-term rewards. Nofsinger pulls in the famous marshmallow experiment, where children are offered one marshmallow now or two if they wait 15 minutes. The kids who waited? They tended to do better in life decades later, with higher SAT scores, more stable relationships, and better financial habits. Investing is full of marshmallow moments. Do you sell that winning stock now for a quick gain, or hold on and let it grow? Do you skip this month's contribution to cover something urgent or stay consistent? Self-control failures in investing usually show up as undersaving for retirement, overtrading during volatile markets, jumping in and out of positions based on emotion, cashing out early, especially during downturns, neglecting to rebalance portfolios because it feels boring or uncomfortable. All of these behaviors reduce returns, and none of them stem from a lack of knowledge. They come from momentary lapses in discipline. One particularly damaging form of poor self-control is impulsive decision-making during market swings. You know you shouldn't sell after a 10% drop. Your plan says to hold, but the news is screaming recession and Twitter is buzzing with panic. Your fear outweighs your logic. You sell, and in hindsight, you realize the mistake. But the damage is done. Nofsinger also highlights the psychological pain of delayed rewards. Saving for retirement feels unrewarding in the short term. There's no instant gratification, no buzz, no flashy win. But spending, that's immediate pleasure. That's dopamine. So we struggle, not because we don't value our future, but because we feel our present so much more strongly. To combat this, Nofsinger shares practical research-backed techniques that help investors strengthen their self-control. 1. Automate your behavior. If you can't trust your willpower, outsource it. Automatic contributions to retirement accounts or investment apps that round up and invest spare change are powerful tools. They take decision-making off your plate and then remove temptation from the process. Automatic escalation, and where your contribution rate increases by 1% each year, is another brilliant move. You'll barely notice the difference in your paycheck, but your long-term savings will grow exponentially. 2. Create commitment devices. A commitment device is anything that helps you stick to your long-term goals by locking you into them. It could be as simple as setting up a penalty for breaking a financial goal, or using a tool like a Roth IRA, where withdrawing funds early comes with a tax hit. Those little psychological locks reduce impulsivity. Some people even go as far as using separate accounts for different goals. One account is strictly untouchable, the long-term investing fund. Another is for emergencies, and maybe a third is for fun money. Just labeling money this way adds a layer of friction that protects your priorities. 3. Reward yourself strategically. We're wired for rewards, so build them into your financial life. For example, commit to checking your net worth only once a quarter. And if you've stuck to your plan, treat yourself to a modest reward. A nice dinner, a weekend getaway. It keeps the discipline cycle sustainable. 4. Limit your exposure to triggers. If financial news rattles you, avoid it. If watching your portfolio daily makes you panic, stop looking. Out of sight doesn't mean out of control. It means out of temptation. Investors who check their portfolios less often tend to perform better, simply because they react less. Nofsinger also emphasizes habit formation. Self-control gets easier when good decisions become automatic. If investing every month is just what you do, it requires less mental effort and less willpower. Eventually, the friction fades and discipline becomes your default. And let's not forget the empathy gap, our inability to predict how our future selves will feel. We think we'll be rational in a downturn, but when that downturn hits, we feel overwhelmed. The solution? Write a letter to your future self. It may sound silly, but it works. When things are calm, record your strategy, your reasons, your vision. Then, when chaos arrives, read that letter. Let your past self guide you through the storm. Nofsinger closes with a powerful idea. Wealth is a behavior, not just a number. It's built brick by brick through small acts of control repeated over time. Self-control is like a muscle. The more you train it, the stronger it becomes. So if you want to build wealth, real, lasting wealth, don't just study the market, study your mind. Create systems that protect your goals from your impulses. Automate, reinforce, commit. Because the truth is, the biggest threat to your portfolio isn't the market, the Fed, or inflation. It's you on a bad day. And the more self-control you build now, the fewer bad days you'll have to recover from later. Chapter 12. The Physiology of Investing. You're watching the stock ticker in real time. Your portfolio is down again. Your heart beats faster. Your palms start to sweat. You feel a knot in your stomach, maybe even a surge of nausea. You tell yourself to stay calm, but every cell in your body is on edge. You're not just thinking about your money, you're feeling it. Welcome to the fascinating world where biology meets finance. In this chapter, John Nofsinger introduces a surprising but powerful concept. Investing is not just a mental and emotional game. It's a physiological one. Your body reacts to financial decisions in ways you might not even realize, and those reactions can drive your behavior more than any spreadsheet ever could. Let's begin with the basics. Your body is wired for survival. Thousands of years ago, that meant responding quickly to threats, like wild animals or a rival tribe. Today, we're not running from lions, but our brains still interpret financial losses as threats. The same fear centers that once told you to flee a predator now scream when your retirement fund takes a hit. When you experience a financial loss, your amygdala, the brain's fear center, lights up. This triggers the release of stress hormones like cortisol and adrenaline. Your body goes into fight-or-flight mode. Increased heart rate, shallow breathing, reduced digestion, and, most importantly, impaired decision-making. This biological alarm system is fantastic for survival, but terrible for investing. Why? Because fear makes us act fast, and investing rewards patience. Nofsinger dives into studies using brain scans, fMRI, that show how financial decisions activate emotional and reward-based areas of the brain. One study showed participants imagining financial losses triggered more neural activity than imagining gains, meaning we literally feel losses more strongly. That backs up what we've already learned. We're more sensitive to loss than to gain. But this chapter shows us why, because your brain processes loss as a threat to your well-being. It's not just a thought, it's a physical event. And it's not just fear, anticipation of reward, like watching a stock rise or hitting a trading win, activates the brain's dopamine system. Dopamine is the chemical of pleasure and motivation. It feels good, it's addictive, it encourages us to seek that high again, which is why trading can sometimes look eerily similar to gambling. One dangerous result of this dopamine-seeking behavior is overtrading. Investors chase the thrill of gains, opening new positions, tweaking portfolios constantly, looking for that next surge of pleasure. They don't always care if it's logical. They care if it feels good. This behavior mirrors patterns seen in addiction psychology. Some people even experience withdrawal-like symptoms when they stay out of the market too long, especially if they're used to frequent trading. On the flip side, chronic stress from losses or financial uncertainty can lead to burnout. Long-term exposure to elevated cortisol levels impairs memory, increases anxiety, and reduces your ability to focus or make thoughtful decisions. So while short bursts of stress might prompt action, long-term financial stress wears you down and clouds your thinking. Nofsinger also explains how genetics might play a role in risk tolerance. Some people naturally have higher baseline levels of dopamine, meaning they may seek risk and stimulation more often. Others are biologically more cautious. This doesn't mean your biology dooms you. It just means some people need to work harder to override certain impulses. Age plays a role too. As we get older, our prefrontal cortex, the part of the brain that controls rational thinking and impulse regulation, becomes more dominant. Younger people, on the other hand, are more driven by emotion and reward seeking. That's why younger investors might chase returns aggressively, while older investors tend to become more conservative. But even seasoned investors aren't immune. Nofsinger shares a story of a veteran financial advisor who, after watching his portfolio drop during the 2008 crisis, felt actual chest pain and went to the ER, thinking he was having a heart attack. It was anxiety. The body was reacting to perceived danger, even though no physical threat existed. So what does all of this mean for you as an investor? It means your body has a vote in your financial decisions. And if you're not aware of that influence, you'll make choices based on feelings you don't even recognize as biological. Here's how to fight back. 1. Practice body awareness. Start tuning in to how your body feels when you check your investments or hear financial news. Are you clenching your jaw, breathing shallowly, sweating? Recognize those signs as signals, not commands. Just because your body is shouting, "Do something," doesn't mean you have to act. The goal is to notice and pause. 2. Use deep breathing and mindfulness. Slowing your breathing signals safety to your nervous system. It activates the parasympathetic response, which calms your body and restores clear thinking. Meditation, even for 5 minutes a day, has been shown to reduce financial anxiety and improve decision-making. Mindfulness helps you observe your thoughts and feelings without immediately reacting to them. It puts space between stimulus and response, and that space is where smart investing lives. 3. Delay decisions during emotional peaks. If your body is in full stress mode, heart pounding, mind racing, do not act. Take a walk, sleep on it, talk to someone neutral. Emotional states narrow your focus and impair judgment. Calm yourself, then decide. 4. Limit exposure to triggers. If checking your portfolio daily triggers anxiety or elation, reduce the frequency. Set a schedule, maybe once a month, to review and rebalance. The less your body rides that emotional roller coaster, the clearer your decisions will be. 5. Develop a ritual for staying grounded. Many elite investors develop routines that protect their physiology. Morning walks, journaling, breathing exercises, or even taking breaks from markets. These aren't extras. They're part of financial success. 6. Build a support system. Talk to a trusted advisor or accountability partner who can spot when you're acting emotionally. We're not great at noticing our own stress signals, but others often can. Don't go it alone. Nofsinger ends the chapter with a profound insight. Your brain is trying to keep you safe. It's not sabotaging you. It's just overreacting. Your job as an investor is to understand that biological response and design systems that gently, consistently override it. Because real investing success isn't about being a robot. It's about being a human, one who knows their biology, respects its power, and makes smart decisions anyway. So the next time your heart races over a market headline, remember, that's not your portfolio talking. That's your physiology. Breathe, think, then act. Chapter 13. The Meme Investors of 2021. It started with a Reddit thread, a few funny memes, and a lot of online hype. But by the end of January 2021, it became a full-blown cultural and financial phenomenon. Regular people, armed with smartphones and trading apps, taking on Wall Street by pumping stocks like GameStop, AMC, and BlackBerry to the moon. This final chapter of the psychology of investing feels different. It's modern, wild, and almost unbelievable. But John Nofsinger uses it to drive home a powerful truth. The irrational behaviors we've studied throughout this book aren't just academic theories. They played out in real time during one of the strangest investment manias in history. Let's set the scene. GameStop, ticker symbol GME, was a struggling retail chain. Think Blockbuster, but for video games. In the age of digital downloads and Amazon, its business model looked outdated. Wall Street hedge funds had heavily shorted the stock, betting it would continue to decline. Enter Reddit's Wall Street Bets, a chaotic, profanity-laced online community where millions of amateur investors gathered to share ideas, jokes, and, most importantly, emotions. When users discovered that institutional investors were betting heavily against GameStop, a rallying cry formed. Let's buy up the stock, drive the price up, and squeeze the short sellers out of their positions. And they did. GME's price shot from around $17 in early January to over $400 within weeks. People made and lost fortunes almost overnight. AMC theaters, Nokia, and even Bed Bath & Beyond got caught in the wave. News outlets scrambled to explain it. Hedge funds panicked. Robinhood, the free trading app that powered much of this frenzy, restricted trades. Lawsuits were filed, hearings were held, and through it all, memes flourished. But beneath the wild headlines, Nofsinger points out that this wasn't just about money. It was about emotion, identity, rebellion, community. The meme investors of 2021 were driven by many of the psychological forces we've explored throughout the book, all colliding in one unprecedented moment. Let's break those forces down. 1. Social identity and groupthink. Many investors in Wall Street Bets weren't just buying stocks. They were joining a movement. It felt like rebellion. We're the little guys, they're the suits. Let's take them down. The more people joined, the stronger the group identity became. There were inside jokes, nicknames, battle cries like "Hold the Line" and "Diamond Hands." It felt like being part of a revolution. That sense of belonging created groupthink, where individual critical thinking is replaced by collective momentum. People stopped questioning the fundamentals of the stocks. They weren't asking, "Is GameStop worth this price?" They were asking, "Are we going to win this battle?" 2. Representativeness bias. GameStop looked like the kind of stock that should skyrocket in a David versus Goliath narrative, and so investors bought into the story, not the business model. The representativeness bias kicked in. This feels like the next big thing, so it must be. 3. Overconfidence and the illusion of control. Armed with a few days of research, thousands of retail investors believed they had figured out a game the pros had rigged, and for a while, it worked. People made money. That early success fueled overconfidence, a belief that they knew what they were doing and that they were in control. But as we've seen, markets are unpredictable, and when the music stopped, many got hurt. 4. Fear of missing out, FOMO. As the prices soared, media coverage exploded. Everyone from TikTok traders to celebrities was talking about meme stocks. FOMO took over. People who had never traded before opened accounts just to get in on the action. Some mortgaged their homes. Others cashed out retirement accounts. Why? Not logic, fear of missing the party. FOMO is one of the most contagious financial emotions. It overrides caution, logic, and planning. It says, everyone else is getting rich. Why not me? 5. Loss aversion and holding through pain. As prices started falling, many meme investors refused to sell. They believed holding was part of the mission. Even as they watched their gains vanish, they clung to their shares. This wasn't just about money anymore. It was about pride, community, identity. Loss aversion made it hard to sell. Selling meant admitting defeat. It meant letting go of the dream. And in a community driven by diamond hands, giving up wasn't just a financial decision. It felt like betrayal. 6. Moral and emotional investing. For some, meme investing wasn't even about profit. It was about sticking it to the system. Hedge funds had bet against GameStop, the company, its employees, its customers. Retail investors saw themselves as defenders of Main Street. They turned financial decisions into moral ones. That kind of emotional investing isn't based on earnings, revenue, or growth potential. It's based on values, and while values matter in life, they can be dangerous if they override financial fundamentals. So what did we learn from 2021's meme mania? Nofsinger is clear. The meme investors weren't stupid. They were human. They were passionate, emotional, social, and driven by many of the same instincts that affect all investors, just amplified by the internet, social media, and modern trading technology. And that's the point. The psychology of investing hasn't changed, but the environment has. Apps like Robinhood have gamified trading with confetti animations, sleek interfaces, and no-fee trading that encourages more activity. Social media turns market news into viral content. TikTok influencers give stock tips. Reddit becomes a trading floor. In this new landscape, the traditional idea of a calm, rational investor is under siege. Emotion, speed, and connectivity drive decisions more than ever. So how do you stay grounded? 1. Slow down. Fast decisions often lead to bad outcomes. If a stock is going to the moon, it'll still be there after you sleep on it. 2. Do your own research. Not what someone posted in a meme. Look at real numbers. Understand the company. Ask hard questions. 3. Remember your goals. Are you investing for retirement, a house, your kids' college? Don't risk that on hype and headlines. 4. Build a boring foundation. Index funds, diversified portfolios, and regular contributions may not trend on Reddit, but they build real wealth. 5. Understand your emotions. If you're buying because of FOMO or holding because of pride, step back. Your portfolio shouldn't be a battleground for your identity. 6. Separate entertainment from investing. If you want excitement, go to Vegas. If you want wealth, stick to a plan. In the end, the meme stock era wasn't a fluke. It was a mirror. It showed us what happens when psychology meets technology, wrapped in emotion and served up with a side of community hype. It reminded us that we're not just investors. We're people, wired for connection, excitement, and story. But if we want to win in the long game, we have to manage more than our money. We have to manage ourselves. And there we have it, the psychology of investing unpacked, explored, and reflected on. If there's one thing this book teaches us, it's that the biggest factor in your financial success isn't just knowledge or timing. It's you, your emotions, your mindset, your biases. We're all human, and that means we're all vulnerable to making choices based on fear, greed, overconfidence, or even social pressure. But once we become aware of these mental traps, we start to take back control. So whether you're just getting started in your investing journey or you've been in the game for years, the key takeaway is this: learn to master your behavior, because that's what separates smart investors from the rest. Now, I challenge you, don't just listen and move on. Reflect on your own investing habits. What biases have shaped your past decisions? What emotions tend to influence your money moves? And most importantly, what will you do differently now? If this episode gave you value, don't keep it to yourself. Like, share, and subscribe to help us grow this community of thoughtful investors. And we'd love to hear from you. Drop your thoughts in the comments or reach out on social media. Have you caught yourself falling into any of the traps we talked about today? What's your biggest investing lesson so far? Let's keep this conversation going, because when we learn together, we grow together. Until next time, stay mindful, stay curious, and invest not just with your money, but with wisdom.